I know, this is a crypto channel and I should be sticking to my guns, just talking about Bitcoin, just talking about altcoins, but diversification is super important and you do not want to diversify just within crypto because there the correlation is very high. Instead, you want to diversify across asset classes because when crypto goes up, then not necessarily stocks go up as well. When property goes down, then Bitcoin might be holding up relatively well. The correlation coefficient across asset classes is relatively low, meaning you can achieve a much better diversification effect by owning different asset classes, not by owning different assets within an asset class. Now, in this video, I will talk about charts that you have never ever seen before. Promised. The first such chart is the Nasdaq, so US technology stocks, divided by the S&P 500. So we are looking here at relative performance. We are not measuring in US dollars anymore. We are looking at outperformance. How much does tech typically outperform the rest of the stock market? Because the idea is that growth stocks tend to do better than the rest of the market because you take on more risk. Now this is a very long-term chart. It starts in 1985. So that's almost 40 years of data. And this massive run-up that we see here in 98 and 99 is the dot-com bubble, which then burst in the year 2000. So the Nasdaq underperformed the rest of the stock market by almost 70%. Now, isn't this an interesting chart? It tells us that tech stocks have never been that expensive, relatively speaking. Again, not in US dollars, but as a fraction of all of stocks, tech has never been as expensive. Early buyers now will make millions. That's how you get clicks on YouTube, but that's not necessarily how you really make money. The way to make money with crypto is to be more skilled than others, to know more than others, to do blockchain analytics better than others. It's the boring technical content that doesn't do well on YouTube, but that forms skills and that I offer in the premium membership. So there's a lot of tutorials over there, how I approach analyses. And if you join, you also get direct access to me. You can ask me any questions and I reply as fast as I can. We are still below 100 people, so I do have enough time to reply everyone. Feel free to check it out. It's thebitcoinstrategy.com. Now this is especially interesting given that we currently have relatively high interest rates. One might expect that when interest rates rise, this should hurt the growth stocks more, because most of the growth stocks' cash flows are far out in the future. The value of a stock is whatever in the future the dividends of that stock will be, right? Tech stocks might not pay out any dividend right now, but in the future they could, right? For example, for Microsoft, didn't pay any dividends for decades, but now is paying dividends. The value of a stock is all of the future dividend payments, and you have to discount those future dividends much more than the current dividends that you get very shortly in the future. So you discount them with the risk-free rate plus maybe some kind of risk-adjusted multiplier. You discount them more the further they are out in the future. And since most of the cash flow of those growth stocks is far out, maybe 20, 30 years in the future, growth stocks should be hurt more by rising interest rates. You have to discount those cash flows more. Traditional stocks like consumer goods or utilities, they've got a lot of their values in just a few years from now, right? They pay dividends right now. For growth stocks, that's different. But why then? Why are tech stocks so expensive, relatively speaking, when interest rates are that high? The long-term outperformance of the Nasdaq versus the S&P 500 makes sense. There is more risk in growth. And nowadays, tech is a more important fraction of all of the economy. What I don't understand though is why tech stocks didn't at least slightly underperform with those interest rate hikes in the last months. Maybe those stocks can go up because they can adjust their pricing according to inflation, but still, right? Why does the discounting not really work that well here? If you have an answer to this, then please comment this down below. I'd be very interested in what your rationale for this is. Here's another chart you probably haven't seen before. This is gold relative to the S&P 500. The gold price divided by the S&P 500, that's behind me over here. The vertical line is Bretton Woods. This is when you could not anymore convert your US dollars into gold for a fixed rate. The US dollar was not backed by gold anymore. People used their US dollars to buy gold, and so gold even outperformed the S&P 500 by quite a bit, more than 1,500% outperformance versus the S&P 500. Then came the tech boom in the 1980s, and gold underperformed tech stocks by 97%. A subsequent recovery after the dot-com crash, gold outperformed stocks by more than 800%. Now it tends to underperform again, somewhat consolidating. Again, I think this is a very valuable chart, right? It shows us independent of inflation, independent of monetary debasement, because stocks and gold, they all get debased the same way versus US dollars, right? Independent from that effect, where is currently the attention? What is currently the story of the day? Where do people really want to deploy their capital? And gold seems to not be the answer. And yes, Peter Schiff is unlikely going to like that message. He's unlikely going to share a chart like this with you. And probably part of that recent gold underperformance was some reallocation to Bitcoin as well. Bitcoin might now be regarded as the hardest of the monies. I've got a few more of those kinds of charts, but I don't want to make this video too long. So if you found this useful, if you found this interesting, then feel free to subscribe because I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. There's also a free Telegram, link is down below.